When it comes to investing in mutual funds through SIPs, you are given a lot of advice. You are told that you need to kind of invest in a particular day to get the maximum returns. You are told that you should do SIP more frequently, not just monthly, so that your returns are higher. You're also told that you should sometimes stop your SIPs and start later so that you escape down markets or you exit at the peak. Now, are these kind of advice right for you? SIPs are meant to make life simpler for you because you need to invest in a disciplined manner. But by focusing on these nitty-gritties, what happens is that your focus does not remain on regular savings, increasing your savings, and also choosing the right funds and monitoring them. So let us get the basic things about SIP out of the way so that you can focus on the bigger things of saving more or looking at the right choice of funds. So let me take you through three common mistakes or myths that people do with SIPs and how to overcome them. So first the thing is SIP or lump sum, right? If you look at the data here, it will tell you that over different periods, SIPs have outperformed lump sum in some and lump sum has outperformed SIP in others. So this eternal debate of SIP or lump sum is actually not a debate at all, for the simple reason that the returns are entirely dependent on the time period that you are investing in. I'll just take the example here. In the 5-year returns that we are speaking of between 2008 to 23, SIPs actually had a chance to average in correcting markets, which means they can buy more in lower markets. That happened in 2020. So because they had an up phase and a down phase, and they could average more in the down phase, SIP has delivered better in the case of 5-year period. Now let's take the 3-year returns, which was basically from 2020 July to 2023 July. You will see that lump sum has delivered better because SIP started a little late after the last market correction we had, which was in March 2020, and hence it has been averaging on the upside. So when you average on the upside, you don't catch the falling NAVs and you don't average better. As a result, a point in time returns, which is what the lump sum is about, has delivered more because it was not averaging at higher points in the market. But look at the 10-year returns. Returns are roughly the same, for SIP and for lump sum. And, it's even the case with Nifty 500, which is a much larger index if you, see, where it has mid caps and all. SIP probably slightly scored over because it possibly could average a little more because mid caps and small caps are a lot more volatile. But overall, if you had done between 2018 to 23, results are different. If you had done between 2020 to 23, results are different. Over a 10-year period, actually it's averaging out. So what's the lesson in it for us? That this debate is actually a no debate, right? What you should be focusing on is whether you have a lump sum to invest in or you don't have one. If you don't have lump sum to invest in and you're just looking at monthly savings, why bother? Right? You are anyway going to do monthly investments. So there is no decision making involved there. But if you have a large lump sum in hand and the risk of market timing is very much there, you're often told that you should just deploy this using STP, which is a systematic transfer plan, over 3 to 6 months. Look, over 3 to 6 months, no averaging really happens. Your SIP needs a longer period because you can't be sure in this 3 to 6 months you're going to have a correction. And if you have a large sum of several lakhs or sometimes crores, 3 to 6 is definitely not enough. Let's take this period now as I talk. We are going into an election here. We might enter a lot of volatility by the end of 2023 and the beginning of 2024. So if you're going to just finish deploying from here over the next 3 to 6 months, you may not be able to capture that volatility using your SIP. So SIPs ideally have to be done over a long period, obviously. And if it's lump sum and you're going to deploy it through STP, you need at least 18 months, to ensure that there is some market, and sometimes even 24 months. I'm saying 18 months depending on the value, but if it's a large sum, even 24 months to deploy, there's no harm. The risk is higher if you're trying to deploy over a shorter period of time. So focus on that rather than focusing on kind of whether I should put the lump sum or the SIP. It's about phased deployment, and SIPs help you do that. And if you're looking at debt also, you're having a mixed portfolio of equity and debt, other than long duration funds like gilts or corporate bonds, if you're looking at short duration, ultra short, you can put lump sum. It doesn't matter. There isn't much averaging that happens in debt. You can check out primeinvestor.in's article on our website. You will find that in debt we have numbers to say that not much averaging really happens unless the fund is volatile. The volatility happens in long duration funds, gilts, constant maturity, and so on, and not so much in short duration. Similarly, if you're looking to switch between one fund that is not doing well to another fund, don't try to do SIPs. You're wasting your time because you're already invested in the market. You have been invested for a long time. Instead of A fund, you're just moving to B fund, right? There is no question of SIPing there. So these basically are the inefficient, actions that really impact your investing. And you think SIP is a bad way of investing. The fact is you have not used it the right way, and you have not used it to the right instances where you don't need SIP. Like I said, debt, if you have a large sum, part of it is going to debt, please feel free to put the short duration debt right away, right? So these are the things that you can do rather than focusing on whether you should be waiting for a correction to put lump sum. The other big debate is, do I do, especially people with, a reasonable sum of SIP, do I do a daily SIP, do I do a weekly SIP or a monthly SIP, and so on. I'm just giving you some data here. You can actually check out more in the article that I have mentioned here. It is also available in the link below. You will see that again, there is not going to be much of a difference. Like you see here in the Nifty 100, daily and weekly pretty much gave the same XIRR over a 10-year period, and monthly SIP may be marginally lower, but it hardly made any difference to the amount, the final amount, These are just XIRR returns. Similarly, in the Nifty 500, you will see this same thing. So why, kind of fret over this issue? Instead, what you can do, and there's one more issue. It's not just a debate of daily, weekly, or monthly SIP. People also ask which day of the SIP to invest in, right? So typically either it's the beginning of the month or the end of the month, or the middle of the month. We ran a lot of data on this, for several years, and we did find, we can't say that there's absolutely no difference. We did find a very, very marginal difference in returns when people invested over the end of the month, right? It could be, we don't know, it could be that volatility is higher. It typically is because there is your derivative positions are typically closed towards the end of the month, and that could have been the reason for this data. But here again, no conclusive data. There are periods where it has actually not shown any difference. There are periods when there is some difference. So we took a longer period, in this case 10 years, that the data I'm showing you marginally higher, provided you're able to have surplus towards the end of the month. The idea is to quickly stash your surplus as soon as you get your salary into SIPs, right? So that if you're the kind who doesn't have enough towards the end of the month, then it may not be a good idea to do end of month SIPs. But if you are keen to, instead of focusing on this monthly, weekly, daily, doesn't matter. Supposing you're having 4 schemes, you can choose different dates for these 4 schemes so that you're kind of spreading over, right? You can have some schemes on the beginning of the month. You can have the more volatile funds like the mid cap or small caps typically at the end of the month, because in case if our data continues to, it might change, the trend might change. But if data is what it says, the volatility is higher end of the month, may be better off capturing that volatility in more volatile funds, which are mid cap and small cap funds. So you could do that. And if you're doing, again, if you're doing an STP, like I said earlier, don't do very short periods to deploy, always have longer periods to deploy. So if you could actually do this over, 3 dates or maximum 4 dates for 4 weeks, if you wish to do it. If your platform, if you're using an online platform, if it provides, and very importantly, if you have balance in your bank account till the end of the month. Otherwise, like I said, the difference is very marginal. It is only more of a behavioral, it's a satisfaction that you get. You could try this to have different schemes over, different weeks, but all run on monthly SIP. So you may have scheme A on monthly SIP, scheme B on monthly SIP, just on different dates, right? The other thing, very important thing is about stopping SIPs, either in a peak or in a correcting, as soon as a correction starts. And this is where most people stop their wealth building. It is not about the returns. Please remember, SIPs is about building wealth in a disciplined way, right? I'm just giving you a simple example here, of a SIP, started of 10,000 rupees SIP. The final value, if I had done, over the past, few years, would have been, you can see the difference, about 9 lakh 2,000. For example, if I had stopped this whole thing by, say, March 2020, when the market either peaked or the correction started, whichever way you want to look at it, your wealth building literally goes down. It's 3.62 lakhs versus 9 lakhs that I could have made, right? Similarly, if you had stopped and then you got the confidence to start your SIP again in, say, 2021, after the market corrected and started moving up, even then it doesn't add up. 3.62 lakhs plus 3.67 lakhs after a gap, the returns still are low, right? So the point is, your SIPs are not meant really to time the market. So what do I do if I want to time the market? You continue to run your SIPs, but you have additional funds to deploy in market corrections. For example, in March 2020, you don't have to think too hard, use an index fund because there's a broad market correction. Use Nifty 50 index fund, use Nifty 500 index fund and deploy money. Either you keep it in your bank account as surplus or you keep them, in some liquid funds, it's up to you. But you can, in addition to the SIPs that you're already running, you can deploy more money, right? Instead of kind of getting scared and stopping your SIPs, you use the correction to average better. And even when the market is peaking, the idea is not to stop wealth building. The idea is to rebalance. So what do? If you think the market is overvalued, you take a look at your own equity allocation. A 60-40 has gone to, say, 70-30. Yes, your portfolio is inflated. So you go back and readjust it. As in, you don't stop your SIPs. Whatever has been invested, you take off the excess equity and go back to your 60-40 by redeploying them in debt. So that is all that you need to do to ensure that you remove the froth in your portfolio. The idea is not to stop your saving, right? The idea is to kind of rebalance and ensure the risk in your portfolio is curtailed. So those are the things that you can do with SIPs. When you try doing this, you will see that your SIP returns are very good, optimal, and if not better. Try them out and do share this video and do also subscribe to our channel.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.